Okay, so we just navigated over to our PowerOptions suite of tools. What you're looking at here is a trial account to PowerOptions. Remember, you can schedule or you can sign up for a 14-day free trial at any time. Just go to powerop.com, put in your name and email address, and you'll have full access to the site for 14 days. If you just did get started on your trial, I encourage you to take advantage of the 4 steps here. The quick start guide, help you get more familiar with the tools on the site. Want to make sure that you go through that, the quick start guide. There are a variety of flash tutorials to help you get familiar with the tools. We do have a variety of free webinars during the week, live webinars, and of course you can access our vast webinar archive at any time just by clicking the free webinars link. And of course, remember, any trial member or subscriber can schedule a coaching session at any time. All right, so do have some questions coming in. First comes in. It comes from Sam. He says, good afternoon, sir and traders. 5th day in green. Long calls, I think he means SPY 250 March, almost $9 in the money. Okay, so he's been doing some SPY calls right now, maybe some straddles there as well. So Sam will give us some commentary on that going forward, I'm sure, as well on some of his positions also. So hi, Sam. It's great to see you here. Congratulations on the SPY calls. All right, Mark says, a friend asked this question. I'm having trouble thinking about it, so it's my question too. If I have a stock and sell a deep in the money call for a big premium, okay, so you get a big premium up front with the deep in the money call, covered call position, and may be expecting the stock to go down, what is the equivalent? What is this equivalent to? A short put? Example might work with Apple. Sell a call at 50 1 month out. Owner expects Apple to go down. Okay, so this is sort of a protective question. Normally, you may or may not do this. Okay, maybe expecting the stock to go down, and we are long stock. I'm just verifying this. If I have stock and sell a deep in the money call. Okay, so an example on Apple, and you said the 50 strike, okay, 1 month out. Okay, let's take a look on the custom spread tool, and then we're going to bounce back to another tool to look at some of the variations here. So Apple, let's say maybe I got it today or I got it a few days ago, and it's at 152. So let's just put in a buy price of 150. Okay, and I think this is, let's see here. All right, I want to sell a 1 month out. Let's just go to February 15th, 35 days away. And you said a 50 call. Now, remember, I'm saying that I got the stock at 150. You might have a lower cost basis. Going this deep in the money, the bid-ask isn't terrible. But we'll take a look at this in a minute. But the open interest might be so small that it might not be worth it. Now, we have a bid price of 102. The stock price is trading at 152.26. So if I sold this call at the bid price of 101.90, this deep in the money, I'm already below intrinsic, and I have no means to be profitable. All right, it'd be locked into a loss. Even if I'm expecting the stock to go down, I didn't make it up intrinsically. If I get the bid of 102.75, in this case, 1 month out, that's the best price. I'm sorry, the ask price. If I got 102.75 and I own the stock at 150, well, that means I could get 152.75 back. Okay, so I'd have a profit of 275 if I did get assigned. Yes, you're hedged for a large drop. I understand that. But at the same time, you run the risk of only a small profit. Why not just go to maybe the 100? But we'll take a look at that too. You see, if I bought it today, Mark, at 152.26, sold the 50 call, and did get the ask price of 102.75, I'm only getting a max 50 cents of profit for a 1 month trade with extreme protection. I agree. And it's about 60%, 67% downside protection. That's really good. But is it worth it? Best case scenario, I get midpoint. And the midpoint here is going to put us at around 102.40 or so. Okay, so let's take a look here. I'm going to sell this, and I'm just going to let the system grab the midpoint for me, Mark. Sorry, and if I make sure that everything's set there we go. All right, so we would get 102.33 if I had a cost basis of 150. Selling the deep in the money 50 strike from 102.33, I'm going to make 232 or 4.9%. As I mentioned, the downside protection, which is simply the stock price, I'm sorry, the premium divided by the stock price, how far the stock can fall before we're technically losing the money on the position, we're looking at about 69% downside protection. All right, that's fantastic. And this doesn't look too bad. But if you did it right now, the close, naturally we're looking at a max of a 7-cent profit, $7, 0.1%, to have the downside protection. So I'm expecting it to go down, but anywhere above 50, that covered call is still going to be assigned. I'm not expecting it to drop to 50, I'll tell you that. You might be better off if you want better protection. Like I said, maybe we just go to the 100. Still really deep in the money. If you get midpoint here, it's not going to be much better. All right. Still too deep in the money. You're making 0.2%, and that'll happen anywhere above 100. Okay. Now your question, what is this equivalent to? Yes, either strike, the 100 or the 50, is equivalent to a naked put position at the same strike and same expiration. They are parity trades. I don't own the stock. Let's go back to your 50 example real quick. At best, current price, buy it today right before the close at 152.25. Sell this deep in the money because I think the stock is going to go down. I'm in a bullish position expecting the stock to go down. I'd rather use a different strategy. Personally, bear call credit spread, maybe a calendar put spread, maybe just buy a put with a small amount of capital so I'm not risking that much if I'm wrong and the stock goes up. Okay, but we saw at midpoint price, if I bought it today, sell it for 102.33, we're looking at that $6 or $7 or about 0.1%. That would be my return if I let this be assigned if it's anywhere above 50 in 35 days. The equivalent or parity trade to this, oh, of course, and I'm sorry, this would, the total cost would only be about $49.93. Right, I'd only have to put up, I'd pay, the $15,226 to buy the stock, 100 shares, and I'd receive $10,000 back from that enriched premium of that deep in the money. But the time value is only 6 cents, 7 cents, really small, 0.1% return, which happens anywhere above 50. Cost in is $4,993 after all said and done to make about $4,999. We're below intrinsic. Okay, now, parity trade. Same expiration. Same strike. 50 strike put. I sell one. What does this mean? Well, in this case, we saw a bid of 0 and an ask of 3. At best case, I get 1.5 cents. Rounds up to 2 cents. Not likely. Probably be closer to 1 cent. The stock's anywhere above 50, I make the 1 cent. I'd only have to put up $5,000 for one contract for the obligation to potentially buy shares of stock at 50. Okay? The naked put, in my opinion, is a parity trade to a covered call. It has the same exact risk-reward profile. The debate there is which one gives you the best premium. In either case, even if you're expecting the stock to go down, with the naked put we just saw, my obligation if the stock falls is I may have to buy shares of stock at 50. But you're not expecting Apple to go below 50. You're also getting nothing reasonable back for this approach. If you think it's going to go down, you want to structure yourself in a bearish position, maybe a straddle or strangle even, which is all pay and no premium. Simply because if the stock swings one way or the other, you can have higher profits in that direction. Okay? So that is the equivalent. The naked put, short put, you said, a naked put, I still have to put up the money to potentially buy shares of stock at my requirement, and I'm still taking a small premium. But this is so far out of the money for the put and so far in the money for the call, it's not going to be worth it to you financially, even if the stock does drop. If you already own Apple and you're worried about a decline, you may still not want to do this necessarily unless you're planning on exiting the position. What do I mean by that? Let's say I had a great cost basis on Apple of only $120 after original low cost basis, years of managing the position. I've knocked it down to 120. I've been rolling or adjusting, collecting dividends or not collecting dividends, selling out of the money calls, so on and so forth. I've got a cost basis of 120. I'm worried it's going to fall, and I say, you know what? I've got it at 120. This 50 call is selling at 102. If I sell that call, I've got a risk of only about $20 on the position, and I can still get assigned. Oops, did I do a buy? Oh, sorry, folks. Proper 1-to-1 ratio. 100 shares of Apple at 120. Sell one February 50 call. So you still might make 183%. You get assigned at 50. You keep the 102. You've knocked your cost basis down to $17. You get assigned at 50. You make a profit of $3,200 on an investment of $1,767. That's your 183% return. Profit of $3,230. But again, why would I do that? Okay, I've got great protection, and I've got the ability to make 183% return, $3,200. Why don't I just sell it now at 152.30? Make $3,230 right now and not even worry about any of this transaction, commission fee on the option, commission fee if I let it get assigned at 50. Don't have to worry about buying it back. I don't have to worry about it going up further. Okay, that's one way to do it. Also, though, if I had a cost basis of 120 on the stock, rather than generate this premium, which again is just at intrinsic, if not a little bit below, but yeah, you have a cost basis of 120, so you're really hedging your risk to nothing. I get that. But if I have a cost basis at 120, the stock's at 150, and I fear it may fall, but it may still have the potential to go up, I'll tell you the truth, I might be going out to April or June, and with the stock at 152, I might buy 145 put for around 570. What does this do to my position? Now I've got a guaranteed profit of 1930, even if the stock collapses. Right? You were still at 32.30. If you sold the deep in the money call, I get that. But you have no further upside if it continues to move up. If something good comes out at Apple and it jumps to 174, 175, or 190, I'm in the $6,000 profit range, not the $3,000. And the worst I can do is a profit of $1,900, almost $2,000, and it only cost me $570. So if you have an unrealized gain in your stock, you could sell that deep in the money covered call, get about intrinsic value, lock in the gain, and still have a lot of downside protection. But in that scenario, you're probably better off just selling the stock now and taking the profit. If you sell the call, that 50 strike you mentioned, and you want to stay in the stock, if it stays right where it is, you're going to have to pay $102 that you just collected to buy it back, and then try to sell it again. Whereas if I buy this put, if it collapses, I've still locked in some profit on the position. Half, more than half actually. Right now we've got about a $32 unrealized profit in this case. I could lock in $1,900 guaranteed if the stock collapses, but if it moves up, I'm still in a good position as well. I'm in a better position for upside profit, and I could still even sell a call at this point against it too, just not, I don't want to sell it deep in the money because then that would be a bearish position. That's not what I want. Okay? All right, so if you've got a gain in your security, you want to consider closing the position, locking in the gains using a put, which doesn't mean it just goes to zero. You can still manipulate this put as the stock fluctuates to get more gains or to get better risk control or higher guaranteed profit in the position and still have some upside available. To your question specifically, these are just conceptual ideas, but to your question specifically, the naked put is the parity trade to the covered call. Let's look at it just at the money. I buy 100 shares of Apple today at 152. I sell the February 150 strike. Let's go no, I gotta go 150. Normally I'd use the higher strike, but let's just go 150. Okay, so we'll do this covered call at the money, 50-50 shot. So a 3.5% return. We'd pay $15,226 to buy the stock. We'd get $727 back. Worst case scenario, the maximum risk is around $15,000, $14,498, and we could make 3.5% if the stock stays above 150 and we get assigned. The parity trade to this is simply selling the cash secured naked put, not on margin, meaning you will have to put up margin to cover the obligation to buy stock at 150. We prefer to be total cash secured. That's the true parity. If you start using margin, then you increase the percentage risk and you increase the percentage return. It's not really a fair game. What would this do to me? Well, I'd have to put up the $15,000 to potentially buy 100 shares of stock at 150. That's my obligation of the naked put. So instead of buying stock at $15,226, I'm just putting up $15,000 to cover my obligation. I'm getting $517 instead of $730 or so that we saw, $727 we saw with the call. Why is there a $2 difference? Because the call is $2.26 in the money. The put is not. It's out of the money, so it's $517. So in essence, I'm looking to make a maximum return of $518 off of a true risk or obligation of $14,482 for a 3.6% return. That's the naked put. Whereas the parity, the covered call, was looking to make $502. 18 cents more, 16 cents more, almost the same risk. In this case, I may be tempted to use the naked put if I was doing this 50-50 at the money covered call. If I didn't own the stock right now, I might choose to do the naked put. It had a little bit more bang for the buck if I got filled at midpoint. All right, that's the case. See, here's that 728, but remember, the 150 call is 226 in the money. So the max profit is 502, where we saw in the naked put it was 518. They are parity trades, have the same risk reward profile. Instead of buying the stock, if you put up the full cash secured amount to enter the position. But again, I'm going to go ahead and say that I don't know if selling that deep in the money covered call is going to match your personal goals because it's trading so close to intrinsic. You're not going to get any benefit out of getting assigned, and the only way it wouldn't get assigned was if it dropped below 50. Okay, so if that was my expectation, I might want to do a different approach. Okay, Mark says, thanks, that was a helpful survey of the landscape on deep calls and buying puts. Yeah, it all depends on your expectation. And again, just based on it, if I did have that cost basis of 120, Mark, and I was worried about a downturn, I might as well just liquidate now and take the $32 profit. You could sell the in-the-money call as we showed, block in some of that profit, but why risk it falling even though you're getting paid to hold that price? Just get out now. But if you thought it might fall, but that it could still go up, that's when I would use the put to lock in most of my unrealized gain, or a large portion of my unrealized gain, I should say, leave the upside open, and I still have the ability in that case with that put to sell calls later if it does move back up at a higher strike and better premium, or make other adjustments with the put, which won't go to zero. Right? That's why I looked at the April put, because it won't go to zero. I can still manage it in that fashion. Okay, Martin asks a tough question. I know how to answer this, but it's tricky and it's weird. Okay, it's a hard strategy. So Martin asks, what option strategies can be used to profit when the stock movement can go in 3 directions? Well, there's no one position from the start. Okay, there's no position, stock and option combinations that can give you any profit no matter what the stock does, if it goes down, if it goes up, if it stays the same. Straddles and strangles will profit for you if it goes up or down, but you'll have a loss if it stays the same. If you sell a straddle or strangle, specifically a strangle, I don't think I'd do a straddle, but if you ever sold a strangle, if the stock moves down a little bit, you make money. If it moves up a little bit, you make money. If it stays the same, you make money. But if it moves drastically one direction, you have infinite risk to the upside and infinite risk to zero to the downside. I don't think that's what you want. Iron Condor, very similar, a four-leg position around the stock. Let's just take Apple as an example. So I'd want to do an out-of-the-money put spread. I'll do 125, 120, and an out-of-the-money call spread. So I'm doing a bull put credit spread, selling the 125 put around 50 cents, buying the 120 around 33, so I'll make 17 cents premium. And I'm going to sell the 175 call at 41 cents and buy the 180 at 22, so we'll make about 19 cents. Okay? It's a combination of a bull put credit, 125, 120, and a bear call credit. This is an Iron Condor, of course. Four-legged spread, as long as the stock stays above 125 and below 175, all four options expire worthless. You make 7.3%. Apple is actually a lower volatility stock, so there's not a lot of premium here. Now, the structure you're kind of looking for is very strange. It can profit to the upside, it can profit to the downside, and it can profit if the stock stays the same. But it's sort of opposite this short straddle and short strangle, meaning that if the stock moves just up a little bit or down a little bit, you lose money. And it's tricky to build. It's sort of a butterfly, but it's like a ratio butterfly. Okay, so what is a butterfly? A butterfly can be done as calls and puts, or it can be done as an iron butterfly, similar to the Iron Condor I just showed, but where the short put and the short call, the call that we sold in the bear call spread and the put that we sold in the bull put spread, are at the exact same strike price. Again, let's use the 150 call and the 150 put. Now in a butterfly, or an iron butterfly, I would then buy the outside wing as we just did with the Iron Condor. Okay, so I might buy the 160 call and buy the 140 put. So I'm selling the two at the money strikes and buying wings on the outside. This is similar to the Iron Condor, but since we use the same short strike price, we've got a peak premium. You get a high net credit because you're selling two at the money options. Okay, 727 for the February 150 call, 517 for the February 150 put. You're protecting the risk by using some of that capital by the outside wings. Okay, I'm in a 5-point spread. I'm sorry, I'm in a 10-point spread. I'm sorry, I'm doing 150 to 160 on the call side, 150 to 140 on the put. Normally, you can only lose on one side or the other, so your broker is only going to charge you one side of the margin, or $10 per one contract, $1,000 per one contract. You're taking a net credit of 763. The max profit occurs if Apple's right at 150 at February expiration. All four options technically expire worthless. You keep that massive net credit. Your risk is the $10 minus the net credit, so it's low. You've got almost a 3-to-1, my apologies, a 1-to-3 risk-reward ratio. That's fantastic. Problem with butterflies, and why I don't trade them, by the way, in my personal account, is that from what I've seen through testing, yes, I could only lose maybe $200 for the potential to make 760, 236 to 764. This is only at this point do I make that 736. Here it's less. Here it's less. If I just place 10 to 15 iron butterflies, or butterflies with this structure, and assume no management, these need to be managed in order to profit long term, by the way, but I assume no management, most of the time you're going to be right in here, or right down here. Once in a blue moon will you get it exactly right and get that. Other times, October 2018, November 2018, December 2018, you're down here at the maximum loss. Sure, it's only 200, but if this is happening 80% of the time, a little bit of the gain, a little bit of the loss, or sometimes the max loss, this is happening 17% of the time where you're getting $400 to counter 2 of the losses, and this is happening 3% of the time, you're still very negative long term. This has to be managed. The butterflies have to be managed to win long term. So that wasn't Martin's question, but I can take this structure and then say, hey, I'm still getting a credit of $763. What if I take another $470, $480, buy 2 160 calls in the outer wing, buy 2 140 puts. So I'm still short here, but now I'm increasing the wings on the outside. Now I can win if the stock stays the same or moves plus or minus maybe 1% or so, less than 1%. I still do have a reasonable loss here if the stock falls 718, the maximum risk of 718, and if it really takes off, I can profit in one direction or the other. You can adjust these break-evens in this case, sort of the W profit and loss chart here. You can adjust these break-evens tighter or wider by moving these in closer. I could do the 155 calls and the 145 puts instead, only a 5-point difference, but then I'd be entering it at debit. You see, here I'm still at a credit, which gives me this, that profit of 282 if it stays right around 150. But yeah, there's a loss of 718 over here, chance for infinite gain, but that doesn't kick in until we get above 167 or we drop below 132. But this is one of the ways you can create this W chart to profit in all 3 directions. There is no trade that you'll be able to find off the bat with any combinations of ratios, mixing 8-leg strategies or things of that nature where you can have this W structure where it will have no risk. Okay, the market is priced to make sure that doesn't happen. But if, let's say, I legged into this and I got this a few weeks ago when this was at 950 and this was at 710. Oop. And then I waited for the stock to move away from 160. It dropped down to 140 and I got this at 125. And then I waited again and legged into this February 140 put when the stock's where it is today at 208, let's say. Now this is what you want. Wow, man, I just threw in numbers there and I got it directly. This is what you want. But Martin, I cannot believe that any structure, no matter how many legs or what ratio you do, is going to get you to this profit and loss chart from square one. This would involve legging into a position, getting better prices, taking extra risk on this short call and this short put because at one point they wouldn't be covered by the outside wing. But that's sort of what you're looking for. If it can stay the same, move down a little, move up, or if it just shoots up one way or shoots up the other, it's sort of like this ratio butterfly we're looking at here. Okay, you can play around with the numbers, look at that. You're buying 2 extra wings from the ones that you're selling. Oh, this, of course, is still done at a credit. That's why it works. But you won't see that right off the bat. It would have to be legged into one way or the other in order to build that position. And as I mentioned, you're going to have a lot of risk if you try to do that in that case. Okay. All right. Let's see here. Oh, okay. Martin says thank you. I've attempted to do something like this with a radioactive trade at one point that was bulletproof by adding a broken wing butterfly to it, and it just the commissions were too much because I only had 100 shares, and I had to open 2 short legs, 1 extra long leg, but I had to leg into it as a spread and then an extra one. And then after I factored in the commissions, because I had only 100 shares, it was only a $42, $43 stock if I remember correctly. I just thought it wasn't worth it and I did something else. It looks similar to this with a little bit of risk on the end, the peaks of the W's there at the bottom, but that's it. And you could also, someone mentioned, well, could you do this with weeklies? Well, yeah, you can play around with it to try to do it, but if you sell the weeklies, you won't get enough premium. And if you sell a monthly, as we're seeing here, and we bought weeklies closer in, you'd have to get out of that position within the first week, because otherwise then you just have to buy more calls for the next week and the next week, and at that point you're taking away from the credit, right? As you buy week by week by week, you're paying more than if you just bought the wings outright that were a month out in time, right? You'd actually have 4 times the cost. You want to be selling week by week, but that wouldn't give you enough premium to do this at a credit. And if you do it at a debit, well, let's just simulate a debit. When you do it at debit, the peak of the W is underwater. Didn't solve Martin's problem, right? That would be a loss if it stayed the same. Not big, but it would be at a loss. Let's take the actual prices again. Putting these back up, it's still a credit of 282, but where's this loss coming from at 160? Well, think about it. This is a bear call spread. At 150 to 160, we received a credit of 282, and it's a 10-point spread. So if it's at 160, you've lost the full 10 points on the bear call. You keep the premium. There's your loss of 1718. Same way on this side in a bull put. It keeps going up. Okay, it keeps going up because we have the extra wing, but if it's right at these peaks, those 2 protective puts at 140, the 2 protective calls at 160 to cover the shorts go to 0. And then you got to pay the $10 to close that spread, or that short call or that short put. There's your loss. It'll kick in as it keeps going up. Yeah, and as Sam or Martin says, I'm going to investigate further. This is something I don't want to delve into too much here, but you're absolutely right. I'm using real market prices now, Martin, so we could try to play around with this here and say, what if I sold 2 and bought 3? Different combinations. 4 and 5 is another popular ratio that's used with kind of ratio butterflies and ratio condors, things I don't get into. The risk is still high, 954. I don't think it satisfies what you need. There's the 4 to 5. I don't want to say 6 to 7. Is it 8 to 7? Let me try it. 7 and 7. 8 and 8. So we're not doing 2. Oh, that's why, because we're not doing 2 to 1. Yeah, so I could say 5 to 3 is another popular one. And it's still not going to satisfy what you want, but it's just, see, now we're at 1672. Okay, so it's still not satisfying, but you really want double there to keep the risk in control. But then as soon as you start going more than double, the debit starts to take hold and you're not getting it a credit anymore. Okay, so yeah, you could try doing that. You're just increasing the risk unless it's 2 to 1. Okay, the monetary risk unless it's 2 to 1, but that's still always going to increase. If I did 5 to 10, that's still going to increase the monetary risk from what we saw as well. Martin asked a question that I can answer, but there's a lot more in depth. And there's 2 other questions that are in there, so I'll get to your guys' too, because we're on Martin's thought process here. Sam has another question. There's another question I think that came in too. Martin asked, what is the R&R you typically look for? He means risk and reward. Okay. Well, I'm always honest with everyone in the sense that when I look at my portfolio, I keep about 40 to 50%, maybe let's call it 45 to 55% of my capital allocated to options in married puts. Okay. And you could say, what's the risk-reward ratio to that? Well, it's hard to tell because I have infinite upside possibility with only a 4 or 5% downside. But yeah, I'm looking on average my returns over 8 years are 7% return to the upside with a risk of only 4.1%. 4 to 1 to 7, that's good. Now, on a standard collar, similar to the bull put, buy a stock, sell sort of an at or just out of the money call, buy a further out of the money put, I typically look for a win to loss ratio of max risk of around 4%, my average return maybe around 2.8. Now you can see right there with this structure that you probably need to be right 65 to 67% of the time to profit long term. I am in my strategy with what I use for collars, so I keep doing this. It makes less money than my married put portfolio, married put portion of my portfolio. This represents 15 to 20%. Okay, and in bullish markets, if I feel comfortable, I'm going to use out-of-the-money bull put spreads with another 15 to 20%, usually about 15% of my portfolio, 14, 13% actually. We'll call it 15. But I'm selling out of the money puts where I'm looking for a return of around 10%, okay, for a 2-week trade. What does that equate to, Martin? That's about a 22 cent profit, 18 to 22 cents on a 2-point spread. Okay, doesn't seem like that much, and it's not. And it's in 7 to 1 almost. I'm sorry, it's an 8 to 1, 9 to 1 risk-reward ratio. Okay, why do I do something that has a 9 to 1 risk-reward ratio that in a situation like October, November, December could wipe out that portion of my portfolio? Well, number one, only 15% is there. Okay, number two, each spread that I trade represents less than 4% of my total portfolio. So even if I take a whole 100% loss on that position, that bull put spread, I still have 96% of what I started with that month in my portfolio to continue trading. That's discipline. But also I do this because in trading years that were neutral to bullish, I've been averaging, well, we've been showing through the bull put weekly search and things of that nature, about a 92 to 93% success rate with an average return of around 9%. And of course, when we do have a loss, it's not the full loss. The average loss was around 55, 56%, maybe 66%. I can't remember. I'll look that up, but there's going to be more information coming out soon on that. Okay, so this, a lot of people say the bull put spread is not a great risk-reward ratio. By itself, it's not. But if you know when to leave, I left in October. Haven't traded bull put credit spreads since October. I got hurt with 2 spreads in October, but I haven't traded them since then. I also didn't do bear calls because the market was too choppy. But in any case, following a trading plan now, I'm okay taking this 9 to 1 risk-reward ratio if my trading plan and my steps to do it show me that even when I'm not right 92 to 93% of the time, over time, this is still profitable. Okay? And the reason why is because I find it easier that in normal market conditions, God, I wish we had those back, where there's not a sudden shift in the market for any headline news or anything that comes out related to that. By and large, Martin, I am better at picking stocks that 67% of the time, and this is true for the radioactive trades, my collar spreads, 65 to 67% of the time is better in 2018 actually. We showed that in one of the webinars at the end of the year. That I'm good at picking stocks better than 67% of the time that usually move up 3 to 5% within the first 20 to 30 days. Okay, so that's why my portfolio is dominated with diagonal calendar spreads is another 10 to 15% of my portfolio with the standard collars, bull put spreads, and the married puts. When the market changes, I adjust. What I am terrible at, ridiculously terrible at, I'm probably the worst trader at this. I'm just going to be upfront. I am terrible with any consistency of picking a stock that in the next 7 to 15 to 20 days will not move more than plus or minus 1% of its current value. This is why I don't trade short straddles. This is why I don't trade short strangles. This is why I don't trade iron butterflies or all call butterflies or all put butterflies, because those strategies are dependent on 67 to 70 to 75% of the time picking stocks that won't move more than plus or minus 1% or less from this specific strike price in any given market condition. I'd say my success rate at that is 5%. And that's just a guess. And that's probably being generous. I don't do that. That's why I don't trade the butterflies. So I take on a risk reward that doesn't satisfy your needs. I don't enter ratio spreads that have a better risk reward ratio than, say, a bull put credit spread or a back ratio spread, which might have a better risk reward ratio, because I've been fortunate enough, lucky enough to pick stocks that show the movement I want for a bullish skew to move up 3 to 5% within the first 20 to 30 days over time. I'm not good at this at all. So I can't trade those strategies. And with that in mind, someone says, what is a back ratio spread? Okay, so let's take just our bull put spread here. Okay, and 3 to 5 ratio, but let me do that as a 3 to 6. Okay. Is this what I really want? Yeah. Okay, so this is a back ratio put spread. If the stock stays the same or moves up, I make a profit of about, what was that, $305. My monetary requirement here is about $3,000. So it looks like a 10% gain if the stock stays above. If the stock falls now, well, I can lose 10 to 1. This is still a 10 to 1 risk-reward ratio, isn't it? I got a net credit. My monetary risk is $3,000. That occurs here, okay? To make 305, potentially. That's still a 10 to 1 risk-reward ratio. But the benefit is if I'm wrong and it just collapses, I can profit to the downside. I have twice as many long puts as short puts. Put back spread. So here's the problem. If I'm right more often than I'm wrong, 67% of the time, more, and the stock moves up 3 to 5%, I'm only making 300. If the other 30% of the time it falls into this range and I'm losing 1900, I can tell you right now that's losing. Of course, 1 or 2 times I might have this huge drop in profit to the downside to counter some of this, but this is looking to make 300 in my ratio 67% of the time to lose 1900 30% of the time and maybe make 2800 3% of the time. I don't think that those numbers are still going to get me ahead, so I don't trade this strategy because I haven't mastered, honestly, that type of stock selection where I can pick stocks that stay right here to do the opposite, sell 6 and buy 3, which takes on an infinite risk in one direction, which I don't want. I want this. I don't want this. Okay, so that's kind of the case. But that's also the reason why 45–50% of my portfolio are in the radioactive married put concepts, because even if it takes 2 to 3 months to get to a profitable zone that I want to be, I know that I can't lose more than 4% on any position, and I have controlled risk in place as well. Okay, so let's see here. That's where I want to go. Let me just scroll. Okay. All right. Okay, so let's go back here. A couple comments from Sam, and then I've got Fernando. Sam says, this week I've slowed down my trading. I'm not getting the momentum I want to see. Nope, it kind of died, didn't it, Sam? You had a very profitable December, I know. You had a great November as well, but the momentum swings have stopped, and the way things have been going, I'll say, this is you're probably already doing. Hey, let's give it a week, see what happens. Okay. Okay, so Sam is asking the potential profit on a debit spread on Netflix, debit call spread. Similar to the bull put I was talking about, but the advantage of using the debit spreads is you can skew it bullish. You said Netflix, I'm still in Apple, my apologies. We talked about this a little bit last week. One thing I might do with a bull call debit spread that I'd never do with the bull put, one side of that iron butterfly and an iron condor we were looking at, whenever I do a bull put, I always sell out of the money. But Sam's asking about a slightly skewed bull call debit spread by buying a 320 and selling an out of the money 340. Okay. This is to get a lower ratio that you might be interested in, Martin. This is something we looked at last week. Now, right now, the 340 is right at the money on Netflix. Okay. So this bull call debit spread is a 20-point bull call debit spread. I'm going to pay a debit to get into the position. And right now the debit is $11.80. I had paid $28.90 to buy one contract of the 320 call. It's $18 in the money. I'm going to get $17 for selling the just at, slightly out of the money 340 call. My total debit is $11.80. But if the stock's above 340 at expiration, I can essentially buy shares of stock at 320, sell them at 340. I get $20 back from my debit $11.80. Max profit is $820 on an investment of $1,180. Now, Sam, though, says that what would the profit on this be if we had entered the position when Netflix, I know you can hear me typing and you're not seeing anything change, it's because I was just going to the option chain. when Netflix was priced at around 325. So yesterday. Okay, so let me go back to yesterday before the 13-point move today. Stock's at 324.66. Sam did mention it was a 2-week out spread. That's why I took the 25th January series. So let's look at the 25th January series from yesterday's close when Netflix was at 324.66. And at that point, your 320 call was 2170 at midpoint, and the 340, 1215 at midpoint. Okay, so let's use those prices. Let's go back. Let's keep these numbers in mind. Real market prices right now after the move. I'm sorry, 1180 debit to make 20 points later, 820 profit or 69.5%. Had you done this yesterday, we're able to get close to those prices I just showed. We would have bought the 320 call at 2170 when the stock was at 325. We would have sold the 340 for around 1215, I said. All right, so this is a debit now of exactly the same. No. Oh, I'm sorry. I left the box checked for always use market prices. My apologies. Not quite the same. Let's run that again. 2170 yesterday, 1215 for our long. Yes, it's going to be a debit of around $9 or so. That's more like it. So instead of 1180, it would have cost us 955. Max profit, if the stock is above 340, is at 1045 for a profit of 109.40. Nice. You would have gotten better prices. You had a better skew, lower probability at that time, but now after today's movement, you could probably liquidate the position. Well, let's take the numbers that we had. You put this in at 955, and the max profit was at 1045. Okay, so right now you could close it, it looked like, with time value still remaining, Sam, you know, the cost to get in, the debit to get in at midpoint might be the cost to get out at midpoint, which would be 1180. You only would have made about $230 roughly right now with the max profits that will come. There's still time value remaining on these options. That's why it's based on intrinsic if it's up here. If it was an intrinsic, you know, the 340 would be at 0. This would be at 18. You'd get 18 back here and make about 855, 845, 875 or so. Okay? All right. So that's what you'd expect. If you got in yesterday, the max return would be 1045, around 109.4. And if you got in today, remember the cost is 1180 with a max profit of 820. But if you got in yesterday and you tried to liquidate it, you're only making a profit of about 230, which isn't bad. Okay, it's not the max profit, but 230 because both options still have time value. And remember, here you're buying to close the time value. And remember what we talk about with the ATM bell curve, the options that are at the money always have the highest time premium. So although this has a high premium, it's mostly intrinsic and then some time value. It's down here on the ATM, the time value curve. 340's up here. Okay, so it's still costing you a lot of time premium if you want to buy to close that 340 short, which is why you're only making $200 now as the stock took that $13 move, as opposed to the 1045 or the 820 that you were expecting to make. Okay, so there's, now, either way, if I did it yesterday when the stock was at 325, or even if I did it today, although the bull call debit is a parity trade to the bull put credit at the same strikes and same expiration, I'd have the same risk reward if I did the 340 put, I sold a 340 put and bought the 320, but I would have received the credit of 1045, or yesterday the credit of 820 to be risking 1180 if the stock fell below 320. The reason I never do this structure, as it is shown here, or if when it was at 325, when Sam entered this bullish skewed out of the money bull call debit spread, I would never do this with a bull put because I'm selling an in the money put. This can be assigned to me at any time. Okay? is dangerous in that fashion because I didn't really want to own the stock. I didn't want to put up the money to buy 100 shares of Netflix at 340. But if I do the reverse with the bull put and I structure it here, so as Martin mentioned, these skewed bull call debits are closer to a 1-to-1 risk-reward ratio. We saw one that was 1180 risk to an 820 profit. So risk-reward of just over maybe 1.3 to 1, 1.4 to 1.3 to 1. If I did it the other day when Sam did it, it's a debit of, or a risk of 955 to make a profit of 145. All right? So it's closer to 1-to-1. So this has to be more successful than a bull spread taking a 9-to-1 risk-reward ratio. Well, Sam's good at timing trades better than I am from comments he's made over the last year or so. This only had, if he did the spread yesterday, this only had probably a 42% probability of being above 340 and making the maximum profit. Probably with a break even around 329, 323, probably only a 51% chance that the stock would be above break even for even some small return. So you could say, yes, it's a better than 1-to-1 risk-reward ratio, or it's around a 1-to-1 risk-reward ratio, but you're only right 42, 43, 44% of the time long term. Or with this skew, it's better than 1-to-1, but when the stock was at 325, this was probably only at 30% probability of being above the stock price. Yes, stocks fluctuate, but that's what I was talking about with the bull puts. If I develop a criteria where on average, I'm right a little bit more than 89, 90% of the time and taking a 9-to-1 risk-reward ratio, I'm going to be able to profit long term. If I look for any debit spread that has a 1-to-1 risk-reward ratio, the market stacked against me to only be right 45 to 50% of the time. And I need to be right 52, 53, 54% of the time to profit long term. So although this has a lower risk-reward ratio, you still need to be right more often than wrong. And again, I always talk about this in the webinars, the advantage of the married put with having a low risk and leaving the upside open, not capping it as a standard collar, is that I can still be right 50% of the time. But on average, if I'm making 6 or 7% when I'm right and only losing 3 to 4% when I'm wrong, I can actually be right only 48% of the time and still make money long term. Thankfully, I'm still right 62, 63% of the time to profit long term better. And my average, as you've seen me show before at radioactive trading and the fusion, these positions, I think my average gain is 7.1. The average loss is like 4.3 or 4.1, something along those lines. Okay, and I'm right, about 60% of the time. So that's a good win-loss ratio. But if I'm at 1-to-1, even though it looks good on paper, and I say, hey, for every win I make, for every loss I take, I only need to have one win to get back to break even. Well, if you take a 5% loss, you don't need a 5% gain to get back to break even. You need a 5.3% gain. So you still have to be right 51% of the time, 53% of the time in order to profit long term, even with a 1-to-1 risk-reward ratio and the proper structure. And if you do that, you'll be able to achieve it. And if you're right 60 to 70% of the time, you'll be looking really good. But you need to be right that often in order to do it. That's the trade-off. It's not just about which structure gives you the best risk and reward. It's about which structure gives you the best risk and reward, but still has the expectancy of success to make that risk reward profitable over time. That's the second layer of Martin's question that I didn't really extrapolate on, but I showed with the images, but I didn't extrapolate it in that fashion, that there are ways to create spreads, to create positions that have a 1-to-1 risk-reward ratio that can win if the stock stays the same or has a sudden move up or sudden move down with risk in the middle. But to be successful with that strategy, it has to be a structure that also carries the expectancy of profit to make the whole thing worth it for your while long term. And a lot of those structures don't give that. Okay, I did show Martin the butterfly that could profit in 3 ways, but if 55% of the time your stock's moving up or down 4 or 5% and you're in that maximum loss at the bottom peak of the W and it's not exceeding to get to profit in the far right or the far left of the chart, you're going to lose long term. You can't have that. You need to have some swing wildly and probably 30 to 40% stay in the middle, with only 20% going to the outside wings in order for that W profit and loss chart to be successful long term. That's the expectancy with the structure. Not all one-to-one risk-reward ratio structures and options are profitable because of the expectancy as well. Okay, Fernando, I might need some extrapolation here as well. Fernando's comment was, because I don't know which conversation you put this in on, or if this was a new thought, Fernando, I do apologize. And if you had a question in here that disappeared, I apologize. Fernando asked, it was about the W. So we're on the W conversation. Let me get back to the W. We'll use Netflix as a W. We'll do a W butterfly, ratio butterfly with Netflix. Let's just see if we can find one 14 days out. It'll be a different structure, but we're going to keep it the same. So where the price it is, I'm going to go 340, 340. Let's do 5-point spread this time. 345, 335. I might need 10 points to get a better premium. So we're going to sell the at the monies, and I'm going to buy 2 of the outside wings. Good, bad, or terrible. Wow. Let's ignore this position and never look at it again. This is too close. Let's go back to our Apple one that we saw for a month out, because it was a reasonable W profit and loss chart. Not that we like the risk and reward, but it's what I would have used for a standard screenshot if I was to illustrate this in a webinar that I'd put together before. I mean, that was, when we looked at this Apple one earlier, then you think of seeing a perfect, what you'd expect with real market prices, W profit and loss chart. This is it. You know, you've got a little bump here for some profit. You get your max losses here. It's got to recover to get to this full gain or full loss. Okay. So Fernando says, could be an idea to calculate the risk based on the red at now, thinking to keep alive the structure only for a limited time. Okay, so what he's saying, what Fernando's saying is if I use this, okay, this is the profit and loss at the halfway point. Remember, I took the standard February expiration, February 15th. Based on the theoretical pricing models for the options, this is what we'd expect to see on 130. We only have a small loss of 182 if I planned on closing it at the halfway point regardless, or closing it within the next week regardless of where the stock is. So Fernando's argument is, isn't this a better trade because if you close it out early, then you only have these losses or you have these gains? In theory, yes. But what's going to happen if there's a swing down and we drop down to 130? Where we're looking at the halfway point, we might have a big profit. If Apple falls in the next 7 days from 152 to 130, what's that going to do? Well, either it's a broad market decline or some bad news came out on Apple that's going to drive it down, which is going to increase this, which should help you with your long legs, but it's going to devastate the buyback costs on the short legs. Now, as I mentioned, Apple's not that volatile. I mean, we see it move a lot, but it's really not that volatile overall. But let's say 7 days from today, not at the halfway point, Fernando, 7 days from today, 21st or 22nd, this goes down to 130, and I expect the volatilities in that case for that sudden decline to go up to the 0.40 range. Okay? Now, the graph shows me at the halfway point I should have a profit around 432 if the stock's at 130. Okay, so good. Here we're at 566. The volatility helps us in 2 cases and hurts us in 1. It really helps us with the cost of the 140 put that we bought. Those 2 140 puts that we bought. Hurts us a lot with the 150 put that we sold. This call is still going to go to 0 here, that 150. It's going to drop drastically with a 20-point move, as is the 160. Well, still a reasonable gain. Not quite full profit, but still reasonable. Oh, sorry, yeah, it's not quite full risk, but it's still reasonable. Okay, so yes, it's possible to use that idea, but remember, if you're expecting a skew one direction or the other, or if the worst case scenario probably here is, let's say it moves up gradually to the halfway point and it's trading around 160. And that gradual move up, market calming, things of that nature, drops it down to 0.28 across the board. Okay, see, that's where we get into trouble now. See, if the stock market recovers and it starts moving up and the volatilities decrease, you don't get as much back from the long legs, the two long legs that you have. They start to have a lower premium there. And what I thought would have been a profit when they were at 0.33. Now, it's a subtle change, right? 0.33 is break even if the stock gradually goes up to 160 at the halfway point. And we are about an average about 0.34, and there's your break even. See how subtle that is? Four-legged spreads, butterflies, condors, ratios in particular are very sensitive to the volatility shift, and it adds another dimension to planning on where would my position be at the halfway, sorry Fernando, at the halfway point if the volatility worked in my favor or out of my favor, and how much would just a 0.05 movement in volatility or 5% shift in volatility affect this position from profit to loss. Not a big loss, wasn't a big loss, but still not quite hitting the expectations. But you're absolutely right, Fernando. With these kind of skewed positions that do have some time remaining on them, you could run that fashion and see it, but in this case, remember, it's not like a position where you have a positive delta with a married put position or a married put and a spread inside of it, where the options could change implied volatility, but the stock doesn't. Here, all four legs change their implied volatility, and that could drastically affect your position. All right? But yeah, absolutely. That's a good catch. I didn't think about showing it in that way, that you could just look at the halfway point or 5 days out as well. And yeah, volatility is going to affect that one direction or the other. Okay. All right. Martin, you said you think you need $1 to $3 spreads. Everything is give and take. The closer I go away from these, here, you know, if I stayed closer in, or if I used Netflix, but if, let's say I go to January 25th with Apple instead, and you only get the dollar spreads, remember, below 150. Once you cross 150, everything's 2.5. Once you cross 300, everything's 5, right? 5-point spreads. You don't get that single digit. But the skew that happens is that it's not that that really helps you too much. So if I did a butterfly for this expiration, with the 150 and 149, the 150 and the 152.5, 3 to 1 or 2 to 1, but remember, we're still selling the at the monies. My 2 149 puts, what's happening? These are going to be really expensive. These are going to be really expensive. So what does that mean? It means this isn't done at the credit, it's done at the debit. Okay, so there's my debit of 321. You don't get the W because it's all at a loss under here. All right, so when you pay too much for the outside wings in this scenario we're looking at, you're closer to the strike prices together in that scenario. You're paying more for the outside wings. That dissolves this into a debit, which can still have a profit, okay? But all three portions, the peak of the W, the lower peaks of the W, and the middle peak of the W, are all negative. So you just, at this point, you're just buying a straddle, really. Just buy a straddle. Okay, let me do this. At that point, I'm just buying a straddle or a strangle. So here's the maximum risk is 571 with potential profit swinging here. It's a loss all the way in between here. If I'm thinking there's going to be a good movement in that scenario, I'd probably rather do, that's a terrible one. This is 650 risk, but it could swing either direction. It didn't draw me the whole thing as I wanted it to with the 150 and the 149. It's closer to a straddle that'll start to make profit this way too. Let's just do it then. It'll be expensive, but 150 to 150 call put, a straddle. It's more expensive than what you were looking at because you didn't take any premium in to hedge it, but yeah, straddle. Rather than that graph we just showed trying to do the W with only 1-point spreads or 3-point spreads as well. Okay. Oh, Sam also said he did a 295 bull put on Netflix also. for those strategies too, for some of those other strategies. Okay. Yeah, and keep in mind, everyone, I'm not saying that Apple is the best. Sam brings up a good point. He says that you know, for that W profit and loss chart or some of the other structures we were looking at with the butterfly, you know, Apple's not volatile, but what Sam said is, you know, on average, yeah, Apple's not volatile, but news will come out and then Tim Cook might say something and that might make the position more volatile. So that's just back towards the reference I was making to the headline news. You know, anytime that something comes out, the big CEOs seem to be targets now for every little news thing. They're celebrities now, aren't they? They're almost like Hollywood celebrities. I went to check my email today, my Yahoo email today, and the first thing on the front page was all about, you know, Bezos and his affair, divorce, prenup, and everything. And he is the CEO. He should be under scrutiny for people who are invested in Amazon. I completely agree with that. But for most normal people, putting that all over the place, it's I just stumbled over the term, not just headline news, but shock news, and, you know, getting into people's business. And it's all relevant because the big CEOs, the FANG stocks, are under this giant microscope now of everything, and we saw it with Tesla. You know, we saw the issues there, and it was more about the news talking about, well, how can you trust someone that does this? How can you trust someone? And it's news. I agree 100%, but it's become entertainment news now. It's not business news anymore. It's become entertainment news. All right, that's enough of that. You're not here to listen to me ramble. Oh yeah, I forgot about that. Sam points out that he's just showing things out there. I'm not saying anyone should trade these or anyone should research these, but it could be a lot of fun. Sam says that he sees the marijuana shares are all on the move. They came to live there, and they've been jumping around. TLRY, was that up 30, 25 points, 22 points yesterday? I haven't seen that move in a while. I also haven't seen it below 100 because I haven't been following it since a bunch of us got in that discussion over. Yeah, it was above 100 today, and it moved 20 points. That's when I saw it. I didn't realize that it had been below 80. You know, it had moved up to what, 220 at one point over the year, for almost, well, the spike to 300. I remember, Sam, you were talking about that. But yeah, TLRY, you know, showing almost a little cup and handle kind of thing here towards the last couple months, brought down by the market. And you know, CGC, I haven't looked at these in a while because of the massive volatility. Yeah, CGC doing the same thing, has that little bull there and is coming back up. So those are some of the ones there. What else did you mention? NBEV and Oro. Oh yeah, Aurora, right? All on the move there. So Sam's just mentioning that. I'm not going to suggest that these are trades you should make or strategies you should enter as straddles or strangles because they're going to be expensive. Okay. Oh, there you go. Mark says it. I'm sorry. Is that Mark? Yeah, Mark says it looked like a short squeeze today on TLRY. Huge volume in the first half. Take the money on a bull put spread for January 18th. All right. Yeah, so keep an eye on them. Thanks, Sam. I will take an eye on this. Martin says, you're so good at coming from this from so many directions. Well, I know it probably gets complicated sometimes in our discussions for new investors that are just getting into options, and I do appreciate that. But at the same time, it's my goal here on the Friday sessions is to try to show you as much scenarios as possible for the ideas that you have, just to make sure that you're aware of there are pros and cons to everything, and sometimes the cons don't outweigh the pros and vice versa. So we want to make sure we get an in-depth look at everything, not just what is the structure of the trading. Can I make a magic little M profit and loss chart with selling a lot of premium? Can I make a magic W profit and loss chart where I can profit in 3 directions? The answer is options give us options, and any structure or pattern you'd like to see, you could probably do it. But the expectancy of profit then might be thrown out the window for that particular structure. So that's kind of what we like to look at. But I do appreciate that, Martin. I do appreciate that as well. Your comments there and on that. Okay. Great question. Don't have a great answer. Okay. Again, I'm going to be honest with everyone because I just am. Mark says, Michael, what are your indicators on the tone direction of the market. They include these and other market internal indicators, tick, advanced decline, put call ratio, and more. Right now, honestly, I'm in limbo. I'm going to be honest. I was looking for the right term, and limbo, I guess, Mark, is the exact proper term I should use. I'm in limbo. And I'm in limbo mostly because I'm not, okay, let me go this way. Until any progress is made with the shutdown, one direction or the other. Not even going to talk about sides. We're not going to get in a political discussion. But until something starts showing us something one direction of the other. And I know the shutdown hasn't seemed to have affected the market that much. It's affected segments of the market, but it hasn't affected that much. But until I see any progress, I'm not saying a solution, I'm seeing any progress. And right there, let's be honest, there's no progress with that. And there's a whole global economy. It's not just related to this. But until I see confidence in that of moving in a direction positively or even negatively, one way or the other, I'm kind of hesitant to open anything now but married puts and collars. I'm not touching any calendar spreads. I'm not touching any bull puts. I'm not touching any bear calls. I'm not opening any ratio spreads. I'm not even opening any straddles. As Sam said, because it seems like things have settled down, but there's still this tension. Plus, we're in an earnings cycle, and I want to see what happens with some of these bigger names in the earnings that I'm not invested in right now to get a better gauge. I saw some other things today, news articles, which don't really relate to the market in general, but are kind of interesting as far as a global structure. You know, so Ford and Volkswagen looking to make some kind of alliance. I don't know how big it is, but that's, you know, you'd think that was almost unheard of years ago. Ford wanted to be American-made only, didn't need any help from any outside investors, didn't need help from the government during the bailout that GM required, and now they're meeting with Volkswagen, and they're discussing things with Volkswagen, Porsche, Volkswagen. That's kind of interesting. How many other companies are going to need to do that? How many more mergers are we going to see, or buyouts are we going to see for companies trying to be more competitive and picking up the lower ones? I believe in the January effect. We see that a lot. We may have already seen part of it already, but I'm kind of hesitant right now. I haven't posted anything in Fusion recently. I haven't even made any updates to my trades I have open in the Fusion portfolio at Radioactive Trading because I'm just waiting to see what's next. Now, the indicators as far as that goes, the Market Sentiment Tool, it's at neutral right now. And recently, going back, of course we saw, there it is, the history, we were going back to light buys and buys going back a few days, and it was right. You know, it was time to buy. We've seen some movements upwards. We saw that, but now it's drifting back towards neutral. That doesn't mean it's going to go bearish. It might mean things are settling down as far as the 13 indicators that are used, which are some of the ones you mentioned, Mark. Put call volume ratio, stocks hitting the new 52-week high, the volatility index, of course. That was the one I'm looking for, not the SMA. I skipped right over it. Oh, the number of stocks over their SMA 20, that's still bearish. Okay, so some of these, when they start to revert, I might start to consider that as settling down a little bit more and time to open new trades. As I mentioned, I would have liked to have opened a married put in the last day or two. I just didn't with other things going on. I don't think I'm going to go open anything that, even though I was consistently right when I picked the right time, I don't feel it's the right time, Mark, so that's why I'm not opening any bull puts. That's why I'm not opening any any new calendar diagonal spreads. I'm managing the ones that I have. But to be honest with you, that's where I stand. I'm waiting for things to show a little bit more positive hand. I might be missing opportunities. Sam had some good profits. He talked to us today. Some of the positions others mentioned today look very profitable and very good. We saw some structures today that could be profitable in 3 types of the market. But I'm just waiting to see, and though I feel it's trying to push upwards, I'm waiting to see some more confidence across the board and things to settle down, where that next news article might just not snap it in one direction or the other and hurt a structured trade that I'm in. So anything I open now is going to be a collar or a married put where I can't lose more than 4 or 5% of what I invest. Not using a long call or a long put to speculate and then accidentally become undisciplined and invest too much in it where it takes up too much risk in my portfolio. Yeah, so I'm sticking with the married put there with the stock and the put, so the risk is controlled to 6%, and that's 6 to 7 months at a time in the worst case scenario, so I've got a lot of time to manage it. That's where I'm sticking right now until I get more confidence. And when I get more confidence, you'll see it. All right. Oh, I was going to show this. We're going to wrap up soon here. For those of you that didn't see it, want to take a look at it, Sam just posted a comment. I think he's doing it this way, but Sam says he's still buying VXX in case if the market tanks and you've got your long put in SPY. Recent blog articles we posted. There we go. Here's one on the historical tools I posted today. Comes with a little 15-minute video. It's kind of fun. VXX. Thanks for the hedgeries. Play on the word memories. I was trying to be cute. But anyway, this quick blog article is saying that VXX is done. VXX and VXZ will stop trading on January 30th. That's why when you look at the chain for VXX or VXZ, the volatility IPath ETN, you don't see any options beyond January 25th expiration. Okay, they've reached maturation. An exchange traded note, reaches its end cycle after a certain number of years. VXX still at 39.35 and VXZ are terminating. They're done January 29th. The options, last time you traded was January 25th. They've already planned for it. These have been around for, I think, at least a year, at least 10 months, maybe a year. VXXB. This is the VXX Exchange Traded Note B series. 39.37. Tracking VXX evenly. VXZB is the other one. And as you can see, we have expirations all the way up to January 2021. So these are the replacements. They're just going to replace it. It's not going to be VXX. It's going to be VXXB. But if you need to roll positions out further out in time, liquidate your VXX positions and your options if you have them as you get close to rolling it, and roll them into VXXB, or sell your shares of VXX and buy them into VXXB. I don't know if they're transferring them over for you. It's better just to take care of it before the 25th expiration or before the 29th. And this will continue on. And it's the same thing. It's just that it's a new note because it's an exchange-traded note. It's like a bond, similar to a bond that's sponsored by Barclays, sponsored by an underlying bank. Okay. Yeah, so that's just all that is. If you've used VXX or VXZ before to help as a market hedge, you've got to start using VXXB and VXZB. You can read more about that on the blog. And of course, also, as I showed you on the blog, you can also read about the little coaching session we had there on the historical tools and how you can use the historical tools for that as well. Okay. All right. Well, ladies and gentlemen, we are at about 5:52 p.m. 5:55 p.m. Eastern Time. All right, so I just wanted to remind everyone, Karis, that today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions or recommendations. Options do involve risk. We emphasize a lot of that today with the different structures. It may not be suitable for all investors. Upcoming events, of course, next Tuesday, January 15th, we're going to have a presentation on locking in gains and smiling through earnings. And Wednesday on January 16th, this last Wednesday, one of our recent webinars was Credit Spreads, the Basics. Next Wednesday at 12 noon, we'll be doing Credit Spreads Beyond the Basics, taking the next step. And Thursday, January 17th, is a members-only presentation for radioactive traders and Blueprint owners, Fusion subscribers and Blueprint owners. Those of you that are members, you'll see information on that soon. We're going to just have an hour-long webinar on starting to work with the Blueprint and putting up those positions. As you saw, recent posting on the blog, blog.powerup.com, VXX, thanks for the hedgeries. And then the Swift Skills, looking at the historical tools from a coaching session and how we identified, using the Power Options historical tools, the question that was posed to us about seeing which call might be the best for SPY. Recent postings to the YouTube and the webinar archive, of course, Wednesday's webinar, Credit Spreads, the Basics, the historical tools, and our other Friday presentation from last week as well. And Ernie posted something today in the Radioactive Trading blog discussing his fusion adjustments, fusion trade adjustments for Hewlett-Packard, the HPQ position. All right, so remember, if you haven't yet, you like the tools you saw today and you want to take a look, just go to PowerOp.com, put in your name and email address. You have full use of the site for 14 days. Get your free trial. No credit card is required. After that, subscriptions start at $40 per month. And then, of course, those historical tools we talked about, you can upgrade from your existing delayed or real-time service to get the historical tools to do some back testing. And if you have any other questions at any time, send me an email, support@powerop.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. And if you are a trial member subscriber, remember, schedule a coaching session at any time. All right. Yeah, Sam, I'll try to take a look at that. I don't know if Rajiv is on vacation still or if he's just wasn't available today to join us. I didn't see any comments from him. I didn't see if he was in the attendee list either. So, yeah, good stuff. Oh, yeah, Billy Bob's there. Harry's still here. Good, excellent. But no Rajiv. Okay, so we'll maybe see if he's back in next week. Ladies and gentlemen, thank you for your questions. Thank you for spending your time with me today this Friday afternoon. I'll get this webinar converted and posted for you as soon as I can, and we'll let you know when the webinar has been archived. I look forward to seeing you for one of our live presentations next week. I am not sure yet if there will be a Friday session next week, even though it is standard January expiration, but we will let you know one way or the other. Until then, take care, everyone. Have a fantastic weekend. Happy trading. We'll see you soon. Good night.